The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
We've all heard the old adage, hope springs eternal. Well, it's certainly true for investors when they're looking at the market ahead, expecting that the Federal Reserve is going to do what it says it is not going to do, which is cut rates.
Correct.
Last year, there was substantial hope based on expectations of a slowing economy due to the rates having been risen the fastest time in history to 5.5%. And we're sitting here around saying, well, every time the rates have risen substantially in the past, we've ended up slowing the economy and generating a recession. And the Fed tells us, and Janet Yellen of Treasury tells us, that they're going to be able to raise rates, slow the economy, and have no recession this time. And there's another adage, this time is different.
This time is different. They say that a lot, and it's amazing, really, how often investors in Wall Street, for that matter, they get it wrong. What do we read, Don? We read as many as 6 rate cuts this year, and now
7.
the Fed is
actually saw 7.
7 cuts in 12 months, and now they're much closer to, well, we might not cut this year. Who knows? Maybe none. Maybe one in the second half of the year, and maybe not at all. So it's a cottage industry betting on what the Fed's going to do, and it's amazing how often it's wrong.
Well, the adjustment by the bond traders is that the first rate cuts no longer in March. They've conceded that one is not going to happen. So they've moved the bets out to May, and some of them even further out, it depends on how many cuts they're betting on, out into early of 25. But in any event, this week, the week of February 12th, started with 3 Fed presidents going on the speaking tour saying, well, inflation isn't quite resolved, and we're not sure we need to cut rates yet. And out of that, there are 5 more who are hitting the speaking circuit the rest of this week. So we're going to have a lot of pushback from the Fed against the bond traders betting on rate cuts. And the inflation numbers and economic growth came in stronger than expected. And as long as growth is there and inflation is still relatively high, the justification for rate cuts does not exist. So the Fed may just simply take one meeting at a time and say, well, not this time. Well, not this time. And one more time.
I think what happened was, I think the people got, like I said, investors and Wall Street, they got so focused on that soft landing. They got so focused on, we don't want to push the economy into a recession, that they forgot the reason the Fed was cranking rates up was inflation. Not because the economy was out of control to the upside, inflation was out of control, and they're still looking at that 2% target, and they still want to get back down to it. And while inflation has come down some, like you said, Don, it's stalled, and the Fed does not want to have to raise rates after cutting. So they don't want to look like they've gotten it wrong again. They already feel like they're behind the 8 ball, being so late before they started raising rates, which is why they had to raise them so fast. So they don't want to get it wrong on this side. And as long as the economy's strong, like you said, that gives them cover to just say, well, not right now. We're going to let this run. The economy's perking along fine, so we're not forcing a recession, but inflation is not where we want it, so we're just going to leave rates alone. And it sounds like they're pretty comfortable right there.
Well, particularly on the bond market, traders are very active. We don't think of bonds as being a highly volatile asset, but certainly over the last few years, over the last decade or so, bonds actually have had more volatility than stocks through many periods. And investors have been caught wrong on both sides of the equation. One, they didn't think the Fed would ever get around to raising rates as high as they did. And now
Right.
that they're supposed to be cutting rates, they're wrong again on how quickly and how far down these rate cuts are going to come. And when you look at historic averages for inflation and rates of return, we're really close to long-term averages. And our economy has functioned very well post World War II with interest rates in the current range. Now, the interest rates come in both the nominal rate and inflation adjusted or real rate. And the real rate is not that far out of whack. It's still enough that it can slow the economy down. So far, not so much that we would see a recession given the strong labor market. And Atlanta GDP now numbers have been revised up, expecting that we're going to have another pretty decent quarter and likely a strong year ahead of us, which would should prevent the Fed from lowering interest rates as bond traders are anticipating.
Right.
But, and if rates don't fall, I made this point in my weekend analysis of the market. If rates don't fall, the recovery in small cap and mid cap stocks is really going to be difficult to occur because those companies need cheap money to survive. They've got to
Correct.
roll over a massive amount of debt in this year and next year. The mid cap, small cap debt balances that renew in 26 and beyond is relatively small. This year and next year are the critical years. And if they don't get lower interest rates, those companies are going to have trouble making debt service and much less balloon payments. When the
Right.
balloons come due, if they can't qualify for new financing, they're in trouble. We'll
They're
see
stuck. Yep.
bankruptcies. The other issue the Fed really is looking for is to higher rates and the Fed policies for bankers, so the internal banking activity that the Fed does with banks, they're expecting banks to become reticent with new loans. And that isn't happening yet.
Didn't happen yet. Right.
So if they're still making loans, business is still going to be able to hire and expand. That keeps wages up. In fact, it allows them to perhaps raise wages to keep employees on board or to hire new staff. Even if AI doesn't solve all their problem, they're still
Right.
likely to need new staff in other areas.
It's
All of
true.
that adds to the inflationary pressure that the Fed is dealing with.
And there's a lot of inputs there. And I heard a really great analogy once about the Fed and how you should look at what the Fed might or might not do, because people are always making that bet on what's the Fed going to do. Nobody knows. Nobody knows what the Fed's going to do. But there's a school of thought that says you should treat it like a professional driver. So if you're a limo driver or if you're a professional bus driver, they tell you if you're sitting in an intersection and somebody's got their turn signal on, that's the Fed talking. The turn signal is the Fed talking and other people talking about what the Fed's going to do. If you want to know what direction another car is going to go, look at the front tires. That'll tell you where the car is going to go. If they have their left turn signal on, but their tires are facing to the right, they're going to the right. Doesn't
They're
matter
going
what they
right.
say. Yep. So what the Fed does is the tires. So don't listen to all the signals. Watch what the Fed does. Unfortunately, that means we have to wait. We have to wait to watch what the Fed's actually going to do, because the rest of it is just noise. It's not signal, and it's frustrating. And you can look at it, but watch the tires. That's how you're going to figure out where the Fed's going.
One of those signals, excuse me, maybe the front tires coming from the Fed may be in this last presentation that Chairman Powell made with regard to Congress, because he basically told Congress, you guys need to
Yeah.
get your house in order. This ongoing increasing debt to just keep things running as usual isn't going to work forever. And I saw Janet Yellen being pressed at her testimony in Congress, and she said, asked about whether or not there was a point at which financing U.S. operations, federal operations, is going to become impossible.
Right.
She stopped for just a moment to think about this one and said, well, theoretically, ultimately, that could happen. She doesn't believe it's going to happen. However,
Right.
she has been so materially wrong on market issues her entire well, I don't know about her entire career, but her career that I have known of her and followed her comments.
Right.
has been so far wrong. In my book, she has no credibility. Uh,
And Chairman Powell, someone should let him know if you think taming inflation in the largest economy on earth is a big order, telling our Congress to get their house in order, oof, there's a now he's going into the deep into the pool for sure there. We'll see where that goes, but he's not wrong. He's not wrong there.
well, he does have an option to be able to place pressure on them by not lowering interest rates. Then the cost of
Right.
financing federal government becomes really expensive.
They
There's
get hit
so
too.
little
Sure.
room in the discretionary budget that if interest rate costs rise significantly, there will be no discretionary budget. There won't be
Correct.
any money there. So he
It's all
can
going to
put
be
some pressure
interest.
on it. Well, let's go
Yep.
back to the interest rate cut because there's some
Sure.
interesting nuance with that. The Fed has always maintained that it is not politically influenced. They
Correct.
lie through their teeth. That's a politician's rule.
But
So
independently, they lie through their teeth. Yeah. So
so they have now said we're not going to cut rates in March. May is awfully close to June when the announcement would be made. Now,
right.
if they actually cut rates in June and we have a presidential election a few months later,
Mm,
will they not be accused of being political, cutting rates to keep Biden in office or whoever the Democrat nominee is?
right.
They have painted themselves into an even smaller corner in their building where it's more and more difficult to get out. The problem they're facing is one they created themselves because of
Sure.
excessive government intervention, post housing problems, and then accelerated with the decisions post pandemic. And now they're trying to unwind them, and the ramifications of unwinding them they don't want to deal with. They're uncomfortable. Bad decisions require significant surgical intervention to reverse them. I mean, if you're sick and you ignore it, pretty soon, I mean, you end up in the hospital, and if it's depending
Yep.
on the critical nature, then you end up in not in just ER, but in the critical care unit. I mean,
And that's the Fed's problem. They have painted themselves into a corner. It's getting increasingly tighter, and they don't have an option to ignore it. The United States economy and the rest of the world is waiting to see what they're going to do, and they've turned up the temperature on themselves. And so every decision they make from here on is going to be under the microscope, even more than usual. So they've got themselves to blame for it, but they still have to make a decision, and they have to make some sort of rational explanation for what they're doing, and hopefully they can pull that off. That's a tall order.
well, with my comments about there being non-political, all we have to do is go back and look at when President Biden reappointed Chairman Powell to another four-year
Sure.
term. He had been
Right.
holding rates at zero. And 2 weeks after his reappointment was made, all of a sudden we ended up abandoning ZERP policy and going into aggressive rate hiking. No, nothing political about that now that I have
No,
job
no,
security.
that's all based
And
on the data, right? Yeah,
now
mystery
the
data.
issue is that if, if he doesn't lower rates because he doesn't want to look political in this environment, if President Biden or another Democrat isn't the president in the next term, it looks like President Trump would be the likely replacement. He's not likely to keep Chairman Powell in his position. So
Negative. Yeah, they're not going to happen that way.
Powell has political pressure on him, and it certainly looks like he caves to that pressure, or at least responds to it more than he would like to admit to.
Correct. I'd say that's
That's
fair.
from our
Yep.
side looking in.
Yep.
So anyway, the futures market continues to be wrong on this. There's a wide gap in hourly wages. You mentioned inflation. I mean, that's wages are part of the issue that are keeping
Yep.
inflation up. People have money, people are spending, it's maintaining demand, businesses are able to grow, and they are not having to cut prices. Despite the pressure from the administration on businesses to quit charging what they're charging, people are paying for it. They're going out and
Correct.
saying, I want that. I'm going to buy it. I've got the money. I still have job security. So I'm not going to do without. And prices are sustainable. I mean, one of the areas where prices are sustainable is in the automotive industry. If you're a used car
Sure.
buyer and you're in the market, used car prices are off about 25% from their high. New car prices, however, for ICE, internal combustion engine, those prices aren't falling at all. Electric
Right.
vehicle prices are down because the companies are stuck with excess inventory that nobody
Can't sell
wants,
them.
or
Yep.
fewer and fewer people want, as the problems of operation, particularly in winter, have become more widely known
And advertised. Yeah.
and advertised. That's right.
Yeah.
But new car prices for a traditional gasoline or diesel engine, those prices aren't coming down because people are paying for them. My
Yep.
goodness, you want to go in and buy a Suburban. I mean, you probably start somewhere around $60,000. You take on $1,000 a monthly payment for a period of 4, 5, or 6 years, depending on what you buy. I mean, you
True.
used to be able to buy a house for $1,000 a month payment. I saw I
Right.
saw I saw one commentator write that at these prices, if you're going to pay $1,000 a month, be sure you buy a car with lots of amenities in case you do end up living in the car.
Won't be a bad place to stay if it comes to that. That's right. Multitasker. Ugh.
So the prices are coming down from the high. Let me say it another way. Inflation is getting slower. Prices, for the most part, aren't collapsing. Okay.
Right.
Oil prices have come down because China is slowing down. OPEC's tried to cut production, but that hasn't changed anything because the United States is the controller of prices on the world oil energy economy because we're
Yep.
the biggest producer and have the biggest reserves. So there's some softening there. But what the two new generations to inflation do not understand, the millennials and the Z generation, is they believe the administration, we said, we're going to get prices back down. They're not going to get prices back down. The market doesn't work that way. My wife and I were talking about that last night. And I said, when was the last time you saw a 25-cent gasoline? Yeah, these kids, my kids, my grandkids have never seen 25-cent gasoline. And
Nope.
I'm sure yours haven't either.
Don't even know it's possible. And you're right.
Once
When
in,
people get used to paying it, they'll pay it.
once inflation raises prices, they never come all the way back down to the prior level. They're
Right.
just not going to sustain the high price that you just recently went through due to supply demand imbalances. But all of that is a function of the Fed's trying to deal with a lot of data sources. The continuing strength in the labor market is undermining their efforts to bring inflation under control. And as long as that persists, then the bond market betting on lower rates is on the wrong side of that particular trade.
Correct. Yep.
I think that does it for today, Perry.
We'll do it. You bet.
If you haven't signed up for our podcast, subscribe. The link is right below here. Have a great day. If you have questions, you want to call us, contact information is there. We'll be glad to talk with you.